Okay, we'll talk about itemized deductions now. And we'll probably spend less time on this than we would in many other years because the standard deduction is so high in tax years 2018 through 2025 due to the Tax Cut and Jobs Act. So most people, I would say close to 90% of our clients and close to 80% of taxpayers overall take the standard deduction. But for itemized deductions, the goal is you add up these deductions, and if your itemized deductions are more than your standard deduction, you want to take your itemized deductions instead. If your total itemized deductions are less than your standard deduction, you take your standard deduction instead. So you can take whichever one is more beneficial to you. Itemized deductions are broken down into 6 main categories. There's medical and dental expenses. There's deductible taxes you paid. There's deductible interest you paid. There's gifts to charity. There's casualty and theft losses. And then there's other itemized deductions. And this is a short list of about 12 different deductions that you can take on this section. Itemized deductions are deductions that are normally would be considered personal expenses, but Congress has decided to let you deduct them anyway. So this is not going to be any kind of business or rental expenses. So if you have a small business, you're a sole proprietor, you're going to report all of your income expenses on the associated schedule, which is a Schedule C. And if you have a rental property where you're collecting rent and paying property taxes and mortgage interest, all of those expenses will go on the associated schedule, which is a Schedule P. This is just for your personal expenses, so your interest on the home that you live in and the mortgage interest and taxes on the home that you live in, your own medical expenses, not medical expenses for an employee, which might be itself a business expense. The most common reason for itemizing deductions is going to be home ownership, because mortgage interest is usually the largest single item of itemized deductions. And we might see more people itemizing this year and next year because interest rates went much higher in 2023 and 2024 than they had been before. Interest rates are much higher than they used to be, so we might see, and home prices are also much higher, so we might see a lot more people itemizing. On 1040, if you have itemized deductions, you'll put that on down here on line 12. And if you have a standard deduction, you just put the standard deduction on line 12. So whichever one is larger is what you'll put there. So we use Schedule A to calculate your itemized deductions. We'll talk about what belongs in each category here. So again, the categories are medical and dental expenses, deductible taxes, so not all taxes are deductible, deductible interest, not all interest is deductible, gifts to charity, certain casualty losses, and then we'll talk about those half a dozen to a dozen items that belong in other itemized deductions. 99.9% of people who file 1040s are cash basis taxpayers. What that means is you count income or you report income in the year that you receive the money or other payment, and you record expenses in the year that you pay them. So if you have a hospital bill and you haven't paid it, you don't have a deduction for that. Although it does count as paid if you borrow money from a third party to pay that bill. So if you pay your doctor with a credit card, that is considered paid, even if you end up not paying out your credit card.